let's go back to where we ended up. We were talking about different types of loans, and basically the idea was that you have three types of loan. The most expensive, the least accommodating type of loan is the discount loan. You can see this screen I'm sharing with you, and discount loan essentially was a type of loan that you borrowed money, let's say $100,000, and the bank says, okay, we loan you the money, and the interest is 10% for 1 year. So it's $100,000, 10% interest, that means 10% of 100,000 is 10,000. We take the interest now. We collect the interest now. So we take the 10,000, we lend you the rest, 90,000. And you come back 1 year from now and you pay us off the loan, which is 100,000. Pay attention to this. You walk into the bank today, the 9th of February. You ask for a $100,000 loan. The bank says, okay, we give you $100,000 loan. And they say 10%, the $10,000 interest we collect now, February 9, 2022. You come next year, 2023, February 9th, and you pay us back or pay off the loan. How much is the loan? Remember, $100,000. So if you think, you say, oh, wait a second, you gave me 90,000. Why am I paying you 100,000? The answer is very simple. The difference is the interest, except that instead of paying the interest at the end in 2023, they're collecting it in 2022 right off the bat. And that's what it makes the loan very unfriendly and very expensive. Banks don't give discount loan. Legitimate banks don't give discount loan. All right. There are finance companies that resort to that. And basically what they do, these people are in the business of making a lot of money, and they make risky loans. People who have low FICO score, poor credit reports, and they're desperate to get their hand on money, that they go to these finance companies in order to do that. But that's one type of loan that you will see. Another type of loan is interest-only loan. That is, you borrow money for a certain period of time, and you only, during that period, you only pay interest on the amount of loan. So if you borrow $100,000 for 5 years at 10%, every year you only pay $10,000. You only pay the interest every year. At the end of 5th year, when the loan expires, you pay back the amount you borrowed, 100,000. So you basically have interest-only loan for the duration of the loan, and the principal is paid back at the end when the loan is paid back. That is a sort of a loan that lowers your payment. It makes it more affordable. But you have to remember, at the end, you have to come up with a lump sum amount. A lot of people who go with interest-only loan, they end up at the end when they have to pay the whole lump sum amount at the end. And what they do, they finance that. And they borrow that amount, finance it over 10, 20, 15 years, whatever it is. So, but that's the normal practice. That's what happens. But at least for the duration of interest-only loan, your payments are much lower and they are more accommodating. But you have to be prepared to come up with that principal payment. Something similar to that, we call those adjustable rate mortgages, ARM, A-R-M, ARM, adjustable rate mortgage. These are, it works in similar fashion, more or less, except that it says we keep your interest rate very low. We give you a loan for 1% for 5 years. After 5 years, we adjust your interest rate to whatever the market is. So for 5 years, you make mortgage payment based upon 1% interest, a lot less than what you should pay. After 5 years, your rate is adjusted, and normally it goes up. Normally it goes up. So it suddenly jumps to 5 or 6%. And then you have to pay interest for the remaining balance at 6% interest. This is very accommodating to young people such as yourselves. You're starting, you get your first full-time job, or you're newly weds, you want to buy your first house. In order to help you out with the payment, to keep your payments low for the first few years, they do a very low interest rate or even interest only loan. And then after the adjustment period, 5 to 6 years, they adjust the loan and becomes a regular loan at the higher, at the market interest rates. So hopefully during 5 years, you have gotten promoted, you have established yourself, you are making decent sum of money, and you can afford to make a higher mortgage payment. These are, again, relatively expensive, but they are more accommodating. A typical loan is often called amortized loan. Your automobile loan is amortized loan. Most mortgages are amortized loan. All right. Excuse me. Amortized loan basically arranges where the principal and interest payments are combined. So every time you make a loan payment, every time you make a car payment or a mortgage payment, that payment every month, even though it's fixed, that payment combines the principal and interest. A portion of it goes toward interest payment, a portion of it goes toward principal payment. So what happens? During the first few years, most of the larger portion of your payment goes toward interest. Toward the end of the mortgage or toward the end of the loan, most of the payment will go toward principal payment. What that means, by the time the loan expires, when you make your last payment, you have made the last interest payment and last principal payment. You owe nothing at that point. So you make equal payments every month for the duration of the loan. Those payments at the beginning are mostly interest, toward the end are mostly principal payment. Let me give you an interesting personal example. I always, with my automobile loan, as well as my mortgage, I have paid more than my minimum monthly payment. And what has happened is that that shortened, because I paid more, the additional amount I paid went to reduce my principal. So if I was going to pay off my mortgage in 30 years, because every month I kept paying more money, that money goes to reduce my principal. What happened? I paid off my loan in about 22 years, 25 years. With automobile, that has been more pronounced. I pay a larger portion, and if I have 5-year loan, I normally pay it off in 3 years. Now, check this out. The bank, in that case, because I pay more money, if my principal goes down, my interest payment to the bank goes down, and bank makes money off of my interest that is charging me. That's how the bank makes money. So I make the bank very unhappy for paying more, because that reduces my interest payment. So I have a new bank. I refinanced recently. I have a new bank on a mortgage. I was lucky enough to get a very low rate. So it has been since August, I have been doubling my mortgage payment. So my idea is, if my mortgage is, regular mortgage is $1,200, I pay 2,400. So I want the second 1,200 to go to what? Principal, to reduce my loan balance. The bank doesn't like it. So look what they are doing. Look how smart they are. They are taking the first part of the payment. They're saying this is for your, for example, February payment, but you pay double. So we use the second part for March. So as of now, I don't have to pay anything to the bank till May. Why? Because of these double payments, they count them each as a monthly payment. So they push the payment date, my next payment date, out to May. What's the big deal? And by the way, what I do every month, I call them, I drive them crazy. I say, no, that's not what I meant. I want the extra payment I made to go toward my principal, reduce my principal. So they basically bitch and moan, and then they do it. The fact is, I want to reduce the principal, so I pay less interest. The bank wants the whole interest. So instead of reducing the principal, it applies it, and they say, okay, you don't have to make any payment until May. So I will continue after May making payment. That's very interesting how they wised up and they changed the strategy of handling additional principal payment. And that's just for your information. So in the second sub-bullet, it says keep the loan payment fixed, so which will lower your interest payment over time. So as the loan gets older, gets closer to maturity, you make a smaller interest payment. Your actual payment is fixed, but the interest portion of it gets smaller as you go on. The rule says about first 17 years of your mortgage payment, most of the payment goes toward interest. After that, you start paying down the principal. That's what the rule is. Yes, Anthony.
Hello. So how do you know your payments are going towards interest or principal beforehand? Like, how did you catch that red flag?
Oh, I get statement every month.
Yeah.
So I anticipate that my balance to go down, the remaining balance to go down even more than what the statement shows. Also, the statement tells me that this much applied to the month of February, and this much applied to the month of March.
Okay.
And I look and I said, wait a second, March has not come. I have not made any payment in March. So how come it shows payment for March? So that means they took the second part of the payment and applied it to the month of March.
That's why they said you don't have to pay till May, and you're like,
exactly. If these bastards, they're so smart.
they're
they
dumb.
Want to earn every penny. They want
yeah, they are. Legally, it's smart because it wins, but yeah, realistically, it's kind of stupid.
I am very fortunate that I refinanced at the right time. Okay, I'm not saying I'm smart. I'm saying I'm very fortunate that I refinanced at the right time. So my mortgage payment is low. I never double my payment, not even car payment. So that has not been an issue. But I checked with a couple of friends and they say, yes, that's exactly what they're doing in order to maintain principal.
Is there no like checkbox either when you make a mortgage payment that says like put towards next month's principal? Like you always have to call them and bug them?
No, oh, that's a very good point. In fact, I found out, what I do, I will arrange with my bank to send them a check. The bank that I have checking account with, I do online banking. Most of you probably do. And I asked the bank to send them a check. They say, if I go to their website, if I link my checking account to the loan account, then what will happen is I can transfer the money from my checking to their account and check a box and say, I want to go, this portion I want to go to the principal. I can do that then. But my thing is, I'm just a bit old-fashioned. I don't want to give my original bank information.
I don't blame you. Yeah, because
Yeah.
it forces you to get an account with them if you don't already.
Yes,
That can be a
exactly.
hassle. Yeah. Okay. Thank you. I don't want to keep it going.
All right. So we are all set. Let's see. Let me check one thing.
A quick question, Professor.
Yes.
If let's say someone had a home equity line of credit, but then afterwards they took out the larger amount on credit, how would that be? Would that be processed kind of like it's amortized loan?
Yes. Yes. Except that now that will be treated as a different loan, as a second loan. So you have original loan that you have on the house. I have a second cousin. She's very successful, and she has taken equity. She's young, obviously much younger than I am. She's more aggressive. She doesn't leave cash in the equity of her house. Every time cash is built up, she takes it out and she invests it. So she has 3 mortgages at this time on the same house. One original mortgage and one the second time she borrowed, and now the third time that she has borrowed. And they're all different mortgages, and she makes 3 different payments. And in her case, she makes them to 3 different banks. So yes, it will be treated as a mortgage. It will be treated as amortized mortgage where you pay interest and principal. That is recommended if you are well disciplined and you know what you are going to do with the money. If you take a second mortgage and take a vacation with it, I strongly advise against it. The fact is that you have to pay it off at some point, but you have spent the money. But if you're taking the money now and you're investing it, then that's a different story. I have a friend, a professor of accounting at Cal Poly, and over the years, since 2009, I would say, yes, since 2009, he has bought 5 houses. And what he does is that the value of his house since 2009, original house, went up. He used the equity line of credit, borrowed money, bought a second house. And the rent from the second house pays the mortgage payment on the second house. Now, over a year or 2, both houses accumulate equity. He gets another line of equity and buys a third house. And the mortgage from the third house pays the mortgage payment on the third house. And at the same time, he's building up equity in 3 houses. I don't know if you can picture that. So he has been very, very successful. It's just a bit risky, in my opinion, because you rely on rent to make your mortgage payment. And if you have vacancy, if your house remains vacant, that will be a problem. However, since 2009, the renters market has been very strong and the rent has been consistently going up. And in my opinion, if Fed is going to increase, Federal Reserve is going to increase interest rates, that means the mortgage rates will go up. Fewer people can afford to buy a house. That means they have to rent. And the rent demand for rentals will be still high. He's a very smart guy. He's an aggressive guy, but then he's doing very well.
Yeah, it sounds a little risky, but it sounds like it's paying off. An interesting thing is like for me, because I was a teller for about 2 years at Wells Fargo.
Okay.
Regarding payments, I used to tell customers like that. Some customers would come in and they'll be doing their mortgage payments.
Yeah.
And I would ask them, like, most people didn't, but I always ask them, like, do you want the rest to go to principal? Some of them would be paying like almost double the amount.
Okay.
And they'll just say like, oh, I don't care where it goes. I tell them like, well, no, there's a big difference. Like, especially for this amount that you're putting in. I'm like, because if you have this all going towards the principal over time, you're gonna pay it off much faster. Whereas if you just punch, they just tell me to put it all in as a payment. But say, well, if that happens, then your next statement is just gonna say you don't have much to pay.
Yes.
But you're still gonna be paying the same amount of interest later on. Some people,
exactly.
I think the banks, they rely off of customers not knowing it.
Yes.
And by default, the teller systems, the machines, when you're entering it in, it puts everything in its payment. So there's like a little extra box where it says, well, no, swap sum to principal.
Yes, exactly. Yes, you're 100% correct. And the thing with me has been that box to be checked, I keep missing it because I'm not sending the check directly. I'm sending it through my bank. And they basically, even though I keep telling them, apparently their system cannot be adjusted by me telling them once. I have to go back in, ask to be corrected. So the person on the phone has to put an order to correct that. It takes just a bit of time. They always make the adjustment, but it takes just a bit longer. But there is a difference between not having to pay for a few months as opposed to reducing your principal. Exactly what you said. It's 100% correct. And there is always money when there is the term we call it information asymmetry. That means when the same information is not available to two parties. So your bank has more information than the customer. So when customer is not aware, here the bank can take advantage and make money, and there is nothing wrong with that. But that's the way it is. All right. This is what I want you to do. I want you to go to Canvas, please. I'm going to share my Canvas with you. Go to Canvas, go on the navigation, go to your course, go to your course. Go to the navigation panel, find Files, click on Files. When you click on Files, you get in-class example. You want in-class example, not in-class solution, in-class example. Click on that. I already published it. Chapter 6, you should be able to see chapter 6. Go to 3 dots and download it. Download chapter 6. Okay. I already have downloaded it. And go to problem number 1. You should see this. You should see problem number 1. And if you are writing down the problem, is the highlighted yellow is the problem. So your focus should be on the highlighted yellow section. If you need more time to do so, let me know. Nobody is saying anything, so I'm going to start explaining things. If you need more time to set up, again, let me know. I'll slow down.
I think Ducky says his is still downloading.
Oh, okay.
It's funny how much like research is out in the world on like ethics and business, and like how just giving people all the information makes businesses better for everybody. The customer is more satisfied, and the business usually has a stronger customer base, and they're more like loyal and potentially make more money. Like we've gone over it in like 5 of my previous classes, and it's funny how like huge companies just don't take the like the easy advice that's out there from people who like study finance. So they just bank off of people's ignorance. Like it's no one's job. Like everybody should know finance a little bit, but like if you ever want to use money, right? But it's not, nobody's going to be a financial professional. You don't have to be one in your life. So it's like all that, and then all the legal jargon and everything, and then people are sitting out there by themselves, like getting gypped. It's just sad.
Yeah,
It's
it is.
definitely
What happens is that I tell you something funny. About 10 years, 15 years ago, our dean of College of Business came and said, you know what, other universities are teaching ethics. So let us have ethic as a course in our program. And you know, we looked around and there was no textbook for ethics in business. So they were so insisting on teaching ethics, so they adopted the textbook for ethics in medicine. And the professor had to basically change the situations and in the classroom to relate those to a situation in business to teach. So even academically, you wanted to teach ethics related to the field of business, there were not many resources available out there. But since then, as you said, there has been ample of research. So there is no excuse not to have it. Of course, we don't have a course in ethics. The idea came that each subject has to incorporate ethics in its curriculum. So MHR has to do that, FRL has to do that, and so on. So you will see that if you are FRL major and if you are going to sit for CFA exam, a good portion of that has to do with ethics, with the standard code standard of ethics and behavior.
Yeah, you have to swear to be a doctor, right? You have to swear to be ethical, and just off of ethics alone, you can get your license revoked, and it just keeps people. You know, if you're having a bad day, that's, even then it's just something that's like, I still you can't operate so bad that it'll ruin your livelihood. It keeps people in check.
That's
on
true.
a good day and a bad day. I
look
wouldn't
at,
mind
Facebook.
swearing like for other degrees where you have where your service to another citizen. Yeah, I don't know.
Okay, yeah, exactly.
Keeps it in balance.
And I agree with you that there should be a greater emphasis on that. I remember I was teaching the same course, FRL 3000, many years ago, and a young lady asked me about what about the social benefits. She told me that I'm not talking about the social costs or social benefits, and of course, jokingly, I said the social benefit is if my company makes money, it will keep you employed. And if you're employed, you have a job, your life goes on. So that's social benefit. Oh boy, she didn't like that, that answer. And then I had to basically take it more seriously and answer in more or less the same way that a company does not have just the responsibility to make money for itself. The company has the responsibility, excuse me, toward its customers and toward its employees. So a company has to stay in business in order to provide service to the customer or provide employment to its employees. So those are the social responsibilities that we have to take into account. Okay, you have your example. I have these cash flows. 840 in year 1, 1170 in year 2, 1430 in year 3, 1575 in year 4. I want to find the present value. Now, formula-wise, I can write the present value like this, okay? Future value is equal, you can see it here. Future value is equal to present value times 1 plus r to the power t. My future value are stated because I'm asking calculate the present value at 9% discount rate. Excuse me. So I first will put future value, I put 840 equal present value times 1 plus 9% to the power 4. which means I take 840 divided 1 plus 0.09 to the power 1. 1 because it's in year 1. 1170 divided by 1 plus 0.09 to the power 2. Why 2? Because it's in year 2. 1430 divided by 1 plus 0.09 to the power 3, because it's in year 3. And this is in year 4. I calculate each one and write down the answer. The present value of 840 is 770. Present value of 1170 is 984.77 cents, and so on. So this is what we learned from chapter 5, and we carry it over to chapter 6. If you have 4 different cash flows, 840, 1170, 1430, 1575, you cannot add them up. They are in different time periods. They have different time values. You cannot do that. You can either find the present value, their value at time 0, right here, at time 0. So these are the arrows that you see. I bring the value and find the value at time 0 of each one of these. Okay, each one of these arrows represents the value of that cash flow at time 0. Then I add them up. So 840 is worth 770.64. 1575 is worth 1157.77 at time 0. Now I can add them up. And if I want future value, I have to take all of these to year 4 and add them up. So I want you to do something for me. I'm going to ask individually that you do that. Okay, start. If you are there, this is what I want you to do. Take your calculator and do 840, change sign, and press future value. Then 9, you do I or IYR, and you do 1 because it's in year 1. 840 is in year 1. You do 1, and you do compute, calculate the present value. Do that and tell me what your answer is.
I got 770.6422.
Excellent. Do you see the area I highlighted in my formula? 770.64. That's what you calculated, the present value of 840. So I will go to Brandon, Braden, Randolph, and for you, I want you to clear your calculator and put 1170, change sign, future value, 9I, and this time 1170 is in year 2, you put 2N, and compute present value. Tell me what you get.
984.77.
Excellent. And that's the one I have highlighted in my equation box. Okay. So I'll go to Jessica. If you're there, you clear your calculator, put 1430, change sign, future value, 1430, change sign, future value. (9I), 1430 is in the 3rd year, so you change to 3, and you get what? Okay, I guess Jessica is not there. Let's ask Eduardo to do that. Eduardo, would you please do that if you're there? 1430, change sign, future value, 9I, 3N, compute present value.
I'm sorry, Professor. Did you mean me? I saw that there's 2 Jessicas.
Oh, okay. I meant Martinez.
Okay, so Would that be 1,115 with 77?
No. Did you try it on your calculator? Go ahead and try it again.
Okay, so I put in FB 1439 and 3, correct?
Yes.
Can
Compute
I do
present.
it? Can I do it based off of an equation rather than putting it in my calculator?
No,
Because
I want you to put it in your calculator. Oh, you don't have a financial calculator?
no, I do. I forgot it at home.
Oh, okay. All right. It's all right. Don't worry about it. In fact, if you put it in your equation, you have to double check and see if you get $1,104.22.
How would
I
I?
just, sorry, I just wanted to say, I just did it on mine. It was correct. So
Okay. Okay. Who are you?
That was Ethan.
Oh,
Turner?
okay. Okay. Thanks, Ethan. So that's what you get. All right. So let me go to, and you can try it that way, Jessica, and see if you get that number confirmation. I'll go to Edward Chen. And Edward, if you can try, and now the last number, 1575, that's your future value. And you put it for 4N, 9I, and compute present value. What do you get? Okay, Edward doesn't like to talk. Let's go to part G.
Yeah, I got Professor. I got 1,115 and 79 or 77. Sorry.
Okay, all right. So that's the number I have here. So what essentially I've been trying to do is that instead of writing this equation and calculating each one of these, which takes a long time, you can use your financial calculator, find the present value of each one, write it down like this here, add them up. So your final answer is the present value of these cash flows at 9% will be $3,975.40. You have to add all of them up, and that's the answer to the problem. This still is a long way of doing it. So this is what I want you to do. Okay. For those of you who don't have calculator with you, write it down. Okay. The first part is Texas Instrument. This is HP 10B. I don't think anyone has 12C, so let's not worry about that. So 10B people, you write your instruction. 12 Texas Instrument, write your own instructions. Okay. Let me start with 10B. Work with me. Clear your calculator, press C, then press orange key, and C. Orange and C, you clear. Pink, clear. Orange and clear. All right. If you want, I can do a better job. Orange, key, and C. That means clear. Ready? Yes. The key you work with is CFJ, CF sub J. So you put, because in year 0, notice in year 0, I hate it when every time I want to move up and down that disappears. In year 0, I don't have any cash flow. So I will put 0. In year 0, I have no cash flow, I put 0. So wherever you don't have cash flow, you put 0. So I start with year 0, move on to year 1, 2, 3, 4. So I put 0 and look at the display. 0, CFJ. It says CF0. I hope you saw that. If you didn't, try this. 840. That's this first year cash flow. If I press CFJ, it will take CF1. cash flow in year one, CF1. I hope you can see it. 1170, that's cash flow. You press CFJ again, and that will tell you CF2, cash flow in year two. It tells you where it goes. You put 1430, CFJ, and 1575, CFJ. So when you enter all cash flow, you put the interest rate is 9%, 9 IYR, 9 IYR. And then you put the pink or orange key, and you click on PRC. The orange PRC is NPV. You want orange NPV, NPV, net present value. That stands for net present value. It's right here under PRC. And that's your answer, 3975.40. Any questions?
Excuse me, Professor. Is CF the same as CFJ? Because I can't find CFJ on my calculator.
Which one do you have?
I have the Texas Instrument
No,
BA.
no, I have been doing, yeah, you don't have CFJ. I'm going to do yours in a moment.
Okay, thank you.
Yeah, I'm going to do yours in a moment.
Sweet.
So HP people are fine? Good. Let's go to Texas Instrument. You have Texas Instrument. It's very important how to clear it. It's just a bit more involved. Okay, so this is how you clear it. CEC, that's the part I don't like. Okay, CEC. And then you do second, you do cash flow. Doesn't matter if you have done it before or not. Press CF key, CF key. CF key is next to second key. CF key, you press CF key. Second, CEC. Right here, clear, CF, second, CEC. That will clear the memory. Okay, press CF key again, CF key again. It says cash flow 0. It says cash flow 0. You put, because in year 0, your cash flow is 0, you put 0. Enter key on top. Enter key on top is next to compute. Enter key. Arrow down. There's an arrow down key. 2 keys to the right. It says CO1. CO1 is cash flow in year 1. So you put what? 840. That's your cash flow in year 1. Enter, arrow down. Its calculator tells you FO1. FO1 means frequency. How many times 840 is repeated? Well, obviously, it's only repeated once. And by default, the calculator puts 1. So you can see FO1 is 1 by default. So you don't have to put 1. You put enter, enter, arrow down. It says cash flow in year 2. What is it? 1170. You enter 1170. Enter, arrow down. FO2 again is 1. You enter, arrow down. It says CO3, that's cash flow in year 3, is 1430. You enter, arrow down.
Professor,
FO3, yes.
Say you accidentally click the wrong number while entering, do you have to start over on the whole thing, or is there a way?
I think you can clear it and continue, but I normally prefer to start all over again.
Okay.
You can click clear. I can confirm because I entered in the wrong data.
Yeah,
And I just hit
you
clear and it-
normally should be able, because the previous numbers will stay in the memory.
Okay.
As
Thank
long
you.
as you don't hit enter, you could just like go back up and then go back down to what you were on, and
Yes.
it should be like back to the default one.
Yes, yes. For
Thank-
example, I should be able to go back here and do again 14, 30, assuming I entered it wrong. Enter, arrow down. F is always 1. Enter, arrow down. And finally, I have 15 for year 4, 1575. I enter, arrow down, and frequency is 1. Enter, arrow down. Once I enter the frequency, I'm done. There is no cash flow in year 5. There is no year 5. So that's done. Now here is tricky. Once you're done, you do compute, CPT key, compute, NPV. There is an NPV key under arrow up. Compute, CPT, NPV. Is asking you for interest rate. I is the interest rate. Is asking you for I. You put 9, enter, arrow down. Now you press compute here. You press compute again, and that's your present value, 3975.40. Try it, make sure that you get that number.
I got it.
Good. If anyone is not getting it, let me know.
I didn't get mine at first, but I forgot to hit enter in the values for the last value, fourth
Okay.
value. So yeah, I know why it's off.
Go ahead and try it anyway. Make sure you get it. If you want, you can write the answer down, 39.75 and 40 cents. I'm going to change the problem. Problem number, what is number? Oh, it's problem number 3. I have example and problems. Okay, problem number 3. I have cash flows, 0 in year 1, 1080 in, 0 in year 0, 1080 in year 1, 1310 in year 2, 1530 in year 3, and 2270 in year 4. I want at 12%, I'm asking, what is the future value? What is the future value? You can calculate the formula, as you can see here. Take each cash flow, multiply it by 1 plus interest rate to the power period. Just pay attention. When you go from year 1 to year 4, you're moving 3 years. All right. So from year 1, you go to year 2, that's 1 year. 2 to 3 is 2 years. 3 to 4 is 3 years. So you will put 1080 times 1 plus 12% to the power 3. And then you calculate the future value of 1310, 1530, 2270. Write these down. These are the future values. Add them up. So your answer has to be 74.19. $7,144.19. $7,144.19. That's the final answer, the future value. This takes much longer. You have to take 1 plus 0.12 equal to the power 3, whatever the answer is, times 1080. Write it down. 1 plus 0.12 to the power 2, whatever it is, write it down, times 1310. Write the answer down, 1643.26. So you can see it takes long. So you can use your financial calculator this way. So let me go down and ask people. Let me start with Fernando Perez. Fernando, would you please put this number in your calculator, the highlighted part. 1080, change sign, present value. And for n, it's very easy. You want to go to year 4. I'm asking what is future value? That means what is the value in year 4? So put 4, and 1080 is in year 1. So 4 minus 1 is equal to n. And 12 is I, compute future value. Do you get 1517.32?
Yep.
Write it down. And then I will go to Michelle. Larios, you do the second cash flow. Clear your calculator, do 1310, change sign, present value. But because 1310 is in year 2, so you will do 4 minus 2 equal n. 12i, you compute future value. You get what? Michelle is not talking to me. Okay, let's go to Diego. Diego,
Yeah, I'm typing it in right now. Give me 1 second.
yeah, take your time.
I got
Okay.
1,643.2.
Excellent. That's exactly what we want. Alec Diaz, let's do the third year. You clear your calculator. You do 1530, change sign, present value. You want to go to year 4. We already determined that, but 1530 is in year 3. So you do 4 minus 3 equal n, 12i, compute future value. Are you getting 1730.6? 1713.6.
Yeah.
Very good. Thank you. And Ashton, you do the last one. 2270 plus minus present value. 4 minus 4, because that's in year 4, equal n, 12i, compute future value. You should get the same number, 2270.
Yeah, I got the same number.
Very good. So now you each calculated the present value of 1080, the present value of 1310, the present value, sorry, the future value of 1080, future value of 1310, future value of 1713, and future value of 2270. Add them up, and you get the final answer, which is 7144.19. But this still is taking too long. Now, make a note. With the present value, you have the keys on your calculator. With the future value of a series of cash flows, when you have a whole bunch of cash flows, not just one, a series of cash flows, you don't have a future value key. So you have to improvise. And this is what you do. You take 2 steps. Step 1, you calculate. Step 1, you calculate the present value. Step 2, you calculate the future value. Texas Instrument people, you write down the yellow highlight area. I will come back and show it on the calculator for you. HP people, let me go back up just so Texas Instrument can write clear calculator. HP people, you write down the instructions here. These are the instructions. These are the instructions for you.
Is for Texas Instrument, is the N 4 minus 1 or is it 4 minus 0?
Oh, 4 minus 0.
4 minus 0? Okay,
Yeah.
thanks.
You don't, in fact, have to put 4 minus 0. You can put 4.
No problem.
In fact, let me correct that and just put 4. Let's not make it. Good catch.
Cool. Thanks.
Okay. HP people, work with me. You clear. Notice you clear, and you do orange clear, you're all clear. So you do a two-step. You first calculate present value, then you calculate future value without clearing your calculator any further. So ready? So you put 0 cash flow J, and that will say CF0, because your cash flow in year 0 is 0. Then you put 1080 cash flow J, and that press CF1 will show you. 1310, you keep pressing the same key, CFJ, and that will show you cash flow for year 2. 1530 cash flow in year 3. 2270 cash flow in year 4, you cash flow J. Okay, so you put all 4-year cash flows there. You put 12 IYR, and you compute NPV. NPV is under the key PRC, So you do orange key, NPV, that's your present value, but you want the future value, not the present value. All right, keep that there. Press, okay, answer, press the change of sign, do the change of sign. Do the change of sign, it will put minus in front of it. That's for cosmetic reason. You press present value, you put 12 IYR for N, and press future value. Look at this beauty. You get exact same answer. 71, sorry, it's 71, and this is typo, 7144. Okay, this is 714419. Look at this, 714419, and that's exactly what you have. 714419 rounded. Do the HP people have any questions? Okay. Let's go take this instrument. Remember, you clear, and then you do CF key, but this time pay attention how you clear. You do CF, second CEC, then second FV. You do both. CF, second CEC, second CF. Make sure you clear both. Second FV, you cleared once there, and then CF, second CEC. All right, let's put the cash flows in. Remember, cash flow equals 0 is always 0. So I put 0, enter, arrow down. Cash flow in year 1 is 1080, enter, arrow down. And frequency is always 1. So I enter, arrow down. They say by default is 1. 13, 10, enter, arrow down, enter, arrow down. 15, 30, that's CO3, cash flow in year 3. I enter, arrow down, enter, arrow down. And 22, 70 is cash flow in year 4. Enter, arrow down. Frequency 4, which is 1, you enter, arrow down. If you forget to enter, it will not give you the next CO or FO. So you can use the arrow up key, go back to the last place and enter those properly. Okay. So now that you entered all 5 cash flows, you do compute CPT, and NPV. It will ask the interest rate. You say 12. You enter, arrow down, and you compute again. That they give you present value. You have to take one additional step here. Okay, you take one additional step and don't clear your calculator. Just clear the display, CEC, press that. Do CEC, it gets rid of NPV, change the sign, plus minus, and press present value. 12, IY, 4, N, and compute future value. How the hell did that happen? Okay, let me do it again. Make sure I clear everything. Okay. Let's do compute NPV again. The answer is there. This is it. So I cleared this. Change sign. I'm here. Change sign. Present value. 12. Interest. 4. And compute future value. There you are. I must have entered the wrong key. 71.44 and 19 cents.
Professor.
Yes.
So anytime we see an FO 1, 2, whatever, we can just press enter right away without needing to press 1 enter?
That's correct.
Okay.
In fact, let me try something. You might not even have to do enter, just use the arrow down. Let's see. Let's see if I'm right.
For the test, are we able to use like are we able to like write down like the calculator formulas, or do we have to like memorize?
You
all
have to
this?
memorize it. You have to memorize it. And hopefully, as you do more and more homework, you become familiar with how to use your calculator. That's a good question. You will not get the instructions on the formula sheet. You will see the formula for present value, future value, but no, the instructions will not be there. You're supposed to know how to use it. So if I put 0, enter for cash flow 0, then put 1080, enter, arrow down, and arrow down. Okay. For F, I'm not pressing enter. I'm just clicking arrow down. 1310, enter, arrow down, arrow down. 1530, enter, arrow down, arrow down. 2270, enter, arrow down, arrow down. Okay. Now compute NPV 12, enter, arrow down, compute. Oh no, yeah, that works. So for frequency, you don't even have to enter. You can just use arrow down to get you to see it to the next level. Okay, any questions? All right, the next example. You know what, I have about 1 minute, so let me stop here and we will pick this up on Monday, all right? Don't forget that you have a homework due. Make sure you turn it in. And if you have any questions, I have office hours at starting 2:30 to 3:30. The Zoom link is on the canvas. You can find it if you have any questions. Otherwise, have a nice weekend, and I'll see you back here. Not here. I'll see you back in class on Monday. All right. Take care.
Thanks, Professor.
Thank
Thanks,
you.
See you in class.
Have a good day.